about what it means for what's happening in the world. CNBC is our window on the markets, and markets are our window on the economy.
Right, welcome everyone. We're in the second hour squawk box, which means that it's 7 a.m. in Singapore, 8 a.m. in Tokyo. Let's give you some headlines, shall we? Caution ahead of the Fed. Stocks and bonds moving modestly higher as investors brace for what the Fed will signal. This, as a soft patch of economic data, strengthens the case for those calling for more easing. The US accusing Iran of nuclear blackmail after Tehran said it would soon breach its enriched uranium limits, further undermining the 2015 nuclear pact. And, as US officials say, they are preparing to deploy additional troops to the Middle East. And Chinese President Xi Jinping is set to make his first state visit to North Korea later this week, coming as the US and China are locked in a bitter trade battle. The timing could not be more strategic.
Getting into trade this morning, Japan starts trade at the top of the hour, and we are looking at the CME Nikkei futures drawing a flat line. The close yesterday was also a flat one, and this number right here, the USD against the Japanese yen, well, it hasn't changed one bit. 108.54 coming in on the Japanese currency against the greenback. Let's flip over and look at New Zealand's performance so far into the session. Holding out marginally in the green, about 0.3% higher. There's the SPI futures, which is again indicating that it'll be a quiet open for the Australian market. And for the Aussie dollar against the greenback, this is a new level, 68 cents, a breakdown from 69. And that is pretty much factoring in perhaps a more accommodative stance from the RBA going into the future, and the fact that growth has largely been an area of concern for Australia. But what's also interesting, Shri, is that you look at the markets, you see the futures, and it's indicative of how the markets are being cautious, being a bit tentative ahead of that all-important Fed meet.
And then beyond that, we got G20 as well, and that's going to provide another challenge for the markets.
Seeking direction.
Absolutely. Right, let's get back to the FOMC and the Fed kicking off its two-day meeting later today with Treasury yields softening on the possibility of the Fed signalling a rate cut. We also got Treasury Capital International data for the month of April showing foreign holdings slipping 0.6%. And China's holdings falling 0.7% to $1.1 trillion, the smallest amount since May 2017. Major Wall Street brokerages, in the meanwhile, are split on where the Fed is headed next. Overnight, Morgan Stanley predicted rates would be near zero by spring next year, while on Sunday, Goldman Sachs economists stuck by their stance that the Fed will not cut unless conditions deteriorate significantly. Right, I'm really chuffed to say Tim Seymour is with us once again, CIO of Seymour Asset Management, and he joins us live from New York as our guest host for the hour. Tim, lovely to see you, sir.
Good morning.
So what is the risk here that the Fed disappoints the market, which has more or less convinced itself that the Fed is in the beginning of an easing cycle?
Well, right. So look at Fed Fund futures, which tell you we're basically, 65% of at least a cut this year, and probably closer to 2. And if you ask economists, I think they're in a very different place than where the market is. So obviously, we've effectively priced this Fed cut in, and to the extent that I think the Fed has no reason to be preemptive. In fact, I think they should be reactive here in the face of G20, in the face of what may or may not happen there. I think probably nothing on trade. But it's a Fed that, at least in the last 2 weeks, has gotten more ammunition that price stability, which is another one of their core mandates, is actually at the bottom end of the range and maybe more in jeopardy than it was a month ago at the last meeting. So again, markets have been screaming cut, and I'm not sure that the data right now warrants that.
In fact, that's my next question, Tim. It's really about data versus sentiment. And do you think the Fed would watch the data closely, and will that be a driving force, or would they oblige sentiment? Because there's a growing clamor for a rate cut now, and the markets have rallied in anticipation of that.
So obviously, look, the markets have made the Fed's job a little bit more difficult on some level because they've loosened conditions. So looser market conditions, credit spreads have actually tightened up a bit. Liquidity is certainly flowing freely in markets right now. We're 1.5% off all-time highs in the U.S. So if anything, that's supported price stability on some level, and the Fed is looking at that. From an equity markets perspective, I think you've got a dynamic where actually equities would be rallying in the face of a preemptive Fed. A reactive Fed typically has actually meant that markets have done, let's put it this way, they have not done as well as they have with a preemptive Fed. If you look at the data that we've had over the last couple of weeks that I alluded to, and especially today, you had an Empire Manufacturing Survey, so New York Fed. It's one of a handful of regional Fed surveys, which, while volatile as a series, this is the lowest print we've had since October of 2016. This was a terrible number. It's unequivocal. You've had core PCE, which has been tilting lower, CPI, which has been going lower. So if you're actually worried about the bottom end of price stability, and deflation effectively, then that's something the Fed could be more preemptive on. But again, for equities, we priced this cut in, and I think a Fed that will be reactive to data is not necessarily good for equities if you look at history.
Tim, I really like the point that you made about G20, and deal or no deal, is that point towards the end of June and into early July going to be the inflection point, if you will, that will determine whether the economic data really starts to take a material turn for the worse and forces the Fed to come off the fence?
Right. So I think it will. I think we've got a non-farm payroll number in the first week of July, somewhere in the middle of that U.S. holiday, and you have clearly just the follow-through. And I reiterate this: the CEO surveys we've been seeing, the business confidence, the leading economic indicators, they're all pointing down. By the way, the correlation between today's New York Fed and the ISM is almost 0.9. So it augurs very poorly for the economy. I think in another month, the Fed has a lot more ammunition, and confidence levels were echoed today. So the tactical element of kicking fresh tariffs at least through the 25th, 26th, which means then you have a week's rebuttal period, which gets you through the G20, saves everybody a little face, makes it at least possible for everybody, including the Fed, to really look towards the next meeting.
No, definitely. But here's the thing, Tim. It's almost a toss of a coin whether they'll move in July with a 25 basis points rate cut or in September. And so how do you compare the importance of the two meetings given the underlying macro trends?
I think it's the communication. I think we really have to hear a broad-based dovish adjustment to what we had in the May meeting. And think about the Fed testimony that we had at the beginning of last week. You had almost everybody in the Fed, including Powell himself and Vice Chair Clarida, who what I heard was that this is a Fed that's pointing at 3.2% GDP. I realize backward looking. 3.8% unemployment. I realize backward looking or coincident. But what I heard from the Fed was at least a tone that said their next move is a change in the tone. It doesn't mean that they can't go in July. I think that's what makes June more interesting for folks. But you're right. I mean, the nuance between July and September is very important at this point, and I think the data needs to continue to play in the same direction, because right now it's not as if the U.S. economy is falling off a cliff, and I do think sentiment's very important.
No, absolutely not. I think that's the important aspect. And also we'll watch out for the June data as well, because after April and May, June would be critical in deciding where the Fed goes next from here. And we'll talk more about that after this very short break. But coming up, Chinese President Xi gets set to make his first state visit to North Korea this week in what's being seen as a strategic move with a message, mind you, for the U.S.
Good morning, Mrs. Wong.
Good morning. Your favorite.
Thank you. Good morning, Mrs. Wong.
Good morning. Look what I made for you.
Thank you. Mrs. Wong? Help! Help!
Good thing your grandson was around when you had your fall, Mrs. Wong.
Welcome to the future, the gateway to potential and possibilities. The geographic center of the prosperous Guangdong, Hong Kong, Macau, Greater Bay Area, with 11 main cities and 5 international airports within a 100-kilometer radius, and just 35 minutes away by high-speed rail to West Kowloon in Hong Kong. This is the city of Nansha, home to the largest container terminal in southern China, an international manufacturing hub, with the innovative use of big data and a burgeoning AI industry sparked by R&D centers in the Nansha New Area and Free Trade Zone. This is a city on the move.